Ladies and gentlemen of the crypto space, we're live on a Monday, February 20th at 11:47 a.m. How long can these macro conditions last? Every macro talking head is rightfully talking about how broken the system is, how on the precipice we are of catastrophic liquidity conditions, catastrophic distortions in tax receipts versus the capacity to service debt obligations, CapEx, income versus expense requirements. And they're right. So the question that I wanted to understand and that I do understand, and I'll present to you how I understand it, is why capital is being deployed. We see that. We see capital is being deployed. So I like to work in reverse. If things are appreciating, why are they appreciating? If things are depreciating, why are they depreciating? And generally, that's about liquidity conditions. And that's the kid shit in the pool analogy. If there's cash and it's sitting idle, not doing something, it gets itchy. It's like you go to the casino and you have 100 grand in your pocket and you're sitting on the sidelines. At some point, you're gonna just do something with it. So I know that there are countless indications that the general public in the United States is extremely tight. They're tapped out. Bank accounts are shrinking. Costs and expenses are increasing. Now, the complexity and issue with this perspective is the United States isn't the majority of the capital in the world. The vast majority of capital exists outside of the United States. So you can look to the general public in the United States as a lot of afterburner fuel. You can look at the domestic United States liquidity conditions, Fed balance sheet minus reverse repo minus TGA as afterburner, as turbocharger, because clearly relative at least to U.S. equity indexes, that's where the capital is going to come from fastest. It's domestic. It's right here. Um, but that isn't the aggregate. I would argue in regards that the domestic liquidity conditions in the United States is marginal in the context of global aggregate liquidity conditions. So you all know that I marginalize U.S. equity indexes. I don't really give a shit. They could do what they want. And I'm more interested in outside the United States emerging market liquidity conditions for obvious reasons. You know, we talk about the crypto markets here, and the crypto markets are not a U.S. market, period. End of story. Mic drop. Done. It's not a U.S. market. So there's a relationship, obviously, between liquidity conditions in the rest of the world, liquidity conditions domestically in the United States. Everything affects everything. So clearly, if the United States S&P is tanking, it's going to have an effect on all risk markets because sentiment spans all markets globally. Liquidity spans all markets globally. And that was the coupling. People have talked about the decoupling. When would crypto markets outperform the U.S. equity indexes? And these are the type of conditions where that is possible to occur, where liquidity conditions in the United States are suffering because of increased interest rates. The increased cost of capital is draining domestic liquidity to a degree, and they talk about QT as removing liquidity from the equation. Fed balance sheet minus reverse repo, so the RRP is significantly draining liquidity as well, and QT is reducing the first value in the domestic liquidity equation, Fed balance sheet. So that's not the world. That's just the United States. It's a fraction of global total currency units. And I've been talking most recently that increasing interest rates finally got to the point where it was able to significantly increase global liquidity. And I am stating very clearly recently that that threshold has been breached where bond prices have finally gotten cheap enough that the rest of the world is able to use them to print euro dollars at a cheaper price than on a forex market exchange. buying dollars using euros. And as Ben pointed out very nicely, this has to do with a cross-currency swap being economically favorable. So you could swap euros for dollars, use the dollars to buy the bond, print a euro dollar at a cheaper price than if you purchased a dollar using the euros. And what does that do? That does this. That puts a very sharp top in the DXY. If you no longer need to buy the dollar and you can print a dollar liability, which is a mechanism, a structure, a service offered by offshore banking infrastructure created in the 1950s called the Eurodollar system. That's what puts in a top like this. Bond prices were cheap enough to finally take the pressure off dollar demand. And sure, we can say that oil prices retreated, so that was just confluence. And we see this across the charts. If we look at crude, that's June, but here's October. That's November. So October, November, crude peaked. So there you go. Dollar demand is down. And then if you look on Move, bond price volatility collapsed in October of 22. So now the volatility is down, which means this plays into sentiment volatility. If you could get your bonds at a price point and it's not going all over the place, then you have a source of bonds that is more predictable. This plays into sentiment. So as the bond volatility subsided, and then you look at rates have just been up, bond prices down. So you have a reliable source of relatively cheap bonds in recent history that allows you to finally print a euro dollar at a cheaper price point than purchasing a dollar. So what does that do? So that significantly increases global liquidity without significantly increasing the DXY. As the DXY comes down, risk markets respond favorably. Why? Because as the DXY comes down and you could get dollars cheaper, that frees up euros, that frees up yen, that frees up any currency outside the US to do things with, to purchase things, to speculate, because energy prices have come down. You no longer need to spend as much on energy. You no longer need as many dollars. You can do other things with your foreign currency units. So the observation that is depicted in this chart is what Michael Gaia is talking about, is a rising of the phoenix. From November 2008 to November 2015, interest rates were pinned at zero. I would consider these interest rates pinned at zero anomalies. And what I notice most on this chart is from February 2022 and June 2004. That, to me, appears like a return to normalcy to a degree. This seems like just coming off the heels of a distortion what led up until 2020. And this just threw the system into a complete, like an epileptic fit. It just caused seizures all over the place. And finally, everything snapped with the interest rates going up. So what do I see here? I see a correlation between rising interest rates and a decrease in the inverse spread between bond volatility and dollar price point. DXY is mostly euro and yen. So we could say it's the dollar cost on average, so to speak. Generally speaking, as move comes down, as bond volatility decreases, the dollar comes down. And as the dollar comes down, that juices international liquidity. So what does this chart say? This chart says at a bond price point of a critical threshold, it becomes cheaper to purchase euro dollars than it is to purchase actual dollars. Now, I know these are loaded terminologies, but a lot of what we've been talking about lately is trying to describe what the hell a euro dollar is. I know Jeff Snyder and Emil, they talk about this stuff, but I've been trying to put it into more digestible terminology, and I think we've done justice to that goal. Look at the correlation here. In 2004, as interest rates rose, so this is inverse spread between MOVE and DXY. So as this chart, the green and the red, go up, that is relatively increasing global liquidity conditions. This is not talking about domestic United States, so this doesn't have the same impact on U.S. equity indexes, albeit we know how U.S. equity indexes behaved between 2004 and 2007, then everything collapsed in 2008. So that's why I do the inverse. As this goes down, bond volatility is basically blowing through the roof, and the dollar is basically blowing through the roof, and that drains liquidity conditions everywhere. And down is bad. Down is the system is collapsing. There's a liquidity convulsion. So this chart very much depicts a correlation between increasing interest rates at a critical threshold as significantly increasing systemic liquidity in aggregate for the world, which boosts asset prices. If you have more cash on the sidelines and you get bored because there's low volatility, it's going to get spent and buy things. It's the pool, kid shit in the pool analogy. A volatility event is like a kid shitting at a public swimming pool. Everyone gets out of the pool. Everyone gets out of risk markets. There's 200 people in the pool. The lifeguard gets called into action. They get the net, they scoop the poop out, they get the chlorine, they clean up. Lifeguard then says, all right, guys, wait about an hour or two. Everything's going to get cleaned up. Meanwhile, there's 200 people in the pool. So an hour goes by, 1, 2, 3, 4, 5 people get back in the pool. Everyone's like, all right, it's probably fine. So it takes time. 5 people get that back in the pool, 10, 15, 20, 30, 100. And over time, more and more people get back in the pool. So end of October 2022 was basically where the lifeguard finally got the poop out of the pool, put the chlorine on, and everything was clean. And one person got back in the pool, 2 person got back in the pool. That was end of October of 2022. 2022 was an entire year where a kid crapped in the pool, and the entire year was waiting for the lifeguard to get to the poop. So right now, the system is adjusting to a significant increase in global liquidity, not domestic United States. This is not U.S. equity indexes, and we're interested in crypto markets, which is not a U.S. market. The crypto markets will be significantly more affected by outside of the United States liquidity as compared to inside of the United States liquidity, especially considering the situation going on with consumer price inflation and generally the amount of capital that the public has, which we've been discussing. Bank accounts are going down. So there's not as much capital in the United States. So if we see the crypto market significantly outperforming, we could rationally say it's probably coming from capital outside of the United States, not a U.S. market. So where are we? How long could this last? We see that we finally reached peak bond market volatility and peak dollar Forex price point. October. The 17th of October of 2022 was the bottom here. And that's where interest rates got high enough to take all the pressure off the DXY. And now we're at a little bit of resistance. You can see it more clearly on bond volatility. We're on the monthly chart. So this is the chart that really speaks to me with regard to how long this could last under most favorable circumstances. So I'll elaborate what that means. When bond volatility peaks, there's many months of continuation to the downside. That's exactly what this chart says. In 2020, it was a complete convulsion of liquidity conditions. This wick is disgusting to say the least, but it collapsed. All the artificial injection, whatever the hell they did. But what most interests me on this chart is the fact that I know cycles will cycle. Markets have momentum. Things don't just stop and reverse. It's not like all of a sudden the liquidity conditions are going to just change and all of a sudden markets crash. If there's an event, that's another story. black swan events. So right now we're just discussing under normal conditions the directionality of the market, the nature and likely duration of the cycle. This isn't if Russia does some crazy shit and all of Europe's in a war, or the Bank of Japan implodes and interest rates go to 0.75 and yield curve control is stopped, or they return to 0.25 and the yen is devaluing like it's collapsing. Those would be black swans with regard to liquidity conditions. But guess what? We'll see it on this chart. We'll see it on the EVZ. Euro volatility has collapsed. Since when? October of 22. These charts scream confluence. What happened at the end of October of 22? And they all come back to this chart. Bond volatility collapsed at the end of October of 22. The causality of markets is bond volatility leads to currency volatility, leads to risk market volatility. The bond market is a source of truth. This chart tells us everything that starts the sequence of events that causes markets to basically go up or down. Markets start to come down with a little bit of lag and also go up with a little bit of lag. So this is quite the forward-looking indicator. When this bottoms, you have at least some time to evacuate markets prior to risk volatility significantly kicking in. Now, bear in mind, you have no idea when the hell the bottom is. You see this bottom in September of 2020. September of 2020. Go frickin' figure. September of 2020 was risk off. I remember it quite vividly. September to the end of the year. End of December. January of 21, markets started ripping again. Oh shit. How do you like that? February of 21, bond volatility peaked. This is a wonderful chart that gives you a forward-looking indicator. Now bear in mind, the complexity is noise. So if I'm telling you markets went very risk off in September of 2020 and then basically January of 21 markets started to come back, that's a lot of noise because this is a monthly chart. I like the monthly chart. I don't like daily charts. They'll drive you nuts. You can look at them as forward-looking indicators of weekly and monthly charts to get a sense of maybe where things are going to head. But if you want to see a macro trend, if you want to see directionality and get a sense of duration of the cycle's momentum, got to look at the monthly, maybe at times the weekly. So this is noise. What is not noise? Directionally pushing through a monthly time-weighted average price. And this comes back to the title of the stream. How long could this possibly last? Now, obviously, 2020 was a seizure of markets, but even in 2020, the breach of this TWAP, time-weighted average price, to the downside, look at I had some nice circles. I guess it was on another chart. But look at the meaningful time periods. January of 2017, breach of the TWAP to the downside. The TWAP is the line that goes from red to green, green to red. Let me see if I could clean it up for you. And we'll turn off the averages. There's the TWAP. So how many months? Each candle here is a month. How many months of continuation occurred in the cycle of directionality? I'm not going to count them here, but suffice it to say, on average, when the bond volatility drops below the TWAP, there's about 7 months on average of continued decreasing bond volatility worth of momentum. So we're on month 1. This is retest. And clearly there's the potentiality for invalidation. But we're talking about on average since 2003. I mean, this was a different market prior to 2008. We're in much more artificial conditions. But look how many months of bullish liquidity conditions existed between 2004 and 2007. 3 years of continuously decreasing bond volatility. And what did that do? That juiced international liquidity conditions. Coming off 2008, this was screaming. It was screaming in 2009, August 2009. You had a heck of a bounce, but clearly, look at this. Look at this volatility. This is your bear market rallies, and this is your, is it going to crash? Is it going to stabilize? Is it going to start to go up? This has become quickly one of my most favorite charts. So I expect continuation into the summer. Yeah, there's going to be favorable market conditions with generally upward price action heading into July, August, September, barring a systemic event. So systemic events you'll see on this chart, if shit hits the fan, traditional risk off is back on the table. Why do I say that? Because of this chart. This chart indicates that we have regained correlation between the Fed funds rate and decreasing dollar and bond market volatility. So these are the conditions Michael Guy is looking for, where shit hits the fan, people are going to run to U.S. Treasuries. In the end, we've been discussing how U.S. Treasuries are used outside of the United States. They're used as dollars in the traditional Eurodollar system, which was created in the 1950s. So in a time of scarcity, of uncertainty, of risk, people run to dollars, and bonds are dollars outside of the United States. So I think we'll return to that kind of market dynamic. Just based on what we're seeing, based on this chart predominantly, the correlation between the Fed funds rate and decreasing bond market volatility and dollar demand conditions. It's quite an interesting chart. I like this. This is my favorite so far, other than Move, which is obviously is a primitive chart. Anyway, I hope that helps. Eyes on for some kid shitting in the pool, and that's, you'll see it in the data. You'll see a bit of a forward-looking indicator, especially on Move, especially on the DXY. Now, the DXY is very much at a crossroads. So, as I said, bond market volatility leads to currency market volatility, which basically drives risk market activity. There's only knock-on effects as a relationship between the volatility orders, degrees of separation, meaning clearly currency markets are affected by more things than just the bond market. If energy spikes, dollar demand is going to spike. And the dollar demand versus euro dollar demand is the interesting one. It basically reduces to which one can be purchased cheaper. Which is exactly why if folks want to see risk markets generally appreciate or continue to appreciate, everyone's hoping for this stupid Fed pivot. This chart literally says when the Fed pivots, the euro-dollar discount evaporates, the DXY resumes its bullish trajectory to the moon, and risk markets collapse. When the Fed pivots, it's not going to be a market you want to engage with. When the Fed pivots, bond volatility goes through the roof, currency markets start screaming, the dollar just becomes a wrecking ball, and risk markets collapse. So the pivot is not what you want. You want increasing bond rates. You want more Fed rate hikes. Everyone's screaming Fed pivot. When's the Fed going to pivot? If they get a Fed pivot, they're not going to be happy with it. It's literally look at this. Look at it drives me wild because everyone's screaming the exact opposite from an exuberant standpoint. When's the Fed going to pivot? And macro folks are really not talking about the correlation between these charts at the end of October that suggests the rate hikes finally got to the point of putting in a cheap enough bond price to take the pressure off the DXY with the Eurodollar mechanic. So that's an interesting one that basically no one's talking about, but to me, that's what the chart data says. Raul's in the house. CryptoTube, what's up? Macro talking heads have no idea what's going on, so we come to you, Captain. that's my interpretation of the data. I mean, basically, these charts will tell me to some degree when it's risk off and risk on. It tells you the causality, bond market volatility to currency market volatility to risk market volatility. And this is a completely separate conversation from capital management. So it's not like I've talked anything about what's interesting from an enterprise standpoint, what's an interesting investment. This is literally just assessing the systemic conditions that say generally we're going to have an appreciative or depreciative market. Now, there's plenty of reason to deploy capital if markets are depreciating. And that's a whole nother evaluation involving a risk assessment, evaluating potential opportunity cost, evaluating position sizing. Can you even attain a favorable sized position? That's a whole nother conversation. So everything's related, meaning, if you're going to entertain an investment, you got to assess whether it's a good investment, but you also want to understand what kind of market, what kind of global market you're getting yourself involved with, because that plays into the risk evaluation. Meaning, if there's a lot of risk in macro, you probably can exercise some patience and get a decent discount, which plays into an increasingly favorable position size potentiality. So that's the deal. That's the deal. Roji's in the house. Loki beckons. Hey, Noah, get your thoughts on the market, liquidity, volatility, DXY, oil move. Many thanks. Well, bam, we hit that question pretty good thus far. Dad's in the house. Hope everything is okay. Crazy world out there. But I hope this helps folks get a better sense of what the hell's going on. I got some other charts up for my crypto assets of interest, and we'll talk briefly about them. I don't, I don't really talk about investments too much, but we'll highlight 4 charts. Osarko's in the house. Bill, hey Cap, always a great day when I'm able to see the stream live. What are your thoughts on Hong Kong allowing retail? So that's massive. Come on, with China doing what it's doing, they're injecting a huge amount of liquidity basically into Chinese markets, which basically means international markets, which basically means liquidity conditions outside of the United States. So this is all a setup favorably for crypto markets to significantly outperform U.S. Equity markets. And that would be consistent with what, exuberant folks would have called the decoupling. And I see that in the macro. The macro is set up for decoupling, for crypto to significantly outperform equity indexes. I mean, come on, look at the shit that people buy in equity indexes. I just have such a low opinion of the pig shit that the equity indexes consist of. When I look at crypto markets, I'm like, it's totally digested wrong by the average market actor. Like, these are the penny stocks. Yeah, these aren't the penny stocks. These are enterprise. These businesses have cash flow. These businesses have a tremendous amount of volume. They have a tremendous amount of users. These are basically small cap stocks. If you have a crypto protocol that has $5 billion worth of capital that it's working with, I mean, what's the qualification for, a small cap, big cap? I think a billion and here, that's an interesting one. Small cap, mid cap thresholds. Large cap between 10 and 200. Mid cap between 2. Literally, we're talking about crypto protocols that are mid cap stocks. So I don't know what the fuck TradFi, traditional finance folks, are talking about. They're saying speculating on crypto garbage that's not a currency, it's rat poison, Munger style. We're talking about literally mid-cap companies that are pulling in millions and millions of dollars worth of revenue, dollar-denominated revenue on a yearly basis. I mean, do I need to pull up pure revenue? Now, obviously, there's other protocols. GMX has good revenue, but this is profit, cash income on a weekly basis. Going back to September of 2020, A total of $111 million of income for a system that's mid cap. It's a mid cap stock that made $111 million in 2 years. Fucking shit. Traditional finance does not know what it's talking about in evaluating these systems. They view them myopically, all as a speculation and a gamble, when the appropriate methodology for evaluating these systems is value investing. Now, bear in mind, you can obviously evaluate them from a growth perspective and do your technical analysis and do capital gains and PVP, player versus player, and extract capital from people given the volatility. The volatility allows you to do 100, 200, 300% in a relatively short period of time that you're not going to get even in many of the penny stocks on equity indexes. But on my stream over the years, I discourage that behavior and I favor value investing methodology, looking at the balance sheet, looking at the income versus expenses versus the dividends versus how much debt is on the balance sheet. And the answer is obvious. These companies, these enterprises have zero fucking debt. They have zero real estate expense. They have zero, sometimes they have HR, sometimes they pay salaries, but when they're immutable and deterministic, there's no human resources, there's no employees, it's software. And that's what this protocol is. We're staring at a protocol that has no real estate, no benefits, no health insurance, no human resources department, no employees, that generated $111 million with zero debt on the balance sheet in 2 years. So I don't want to dive too far down the frustration rabbit hole of traditional finance evaluation of crypto protocols. That's why I do what I do. Because they don't know what they're talking about. And clearly, there's some macro observations that I have as well that have not been observed by the aggregate population of macroeconomists as well. Curve looks wonderful from a 3 time frame perspective. First and foremost, it never printed a lower low. And this period of time in November of 22 was a short attack to the tune of countless millions of dollars on literally just millions of dollars of available liquidity. So this was a very, very aggressive attack on the price point. The short attack was wild, and folks probably know what I'm talking about. But look, it still didn't print a lower low relative to historic lows. And obviously this is the log chart, so the non-log chart is more pronounced. But what's most pertinent on this chart is a golden cross on the daily that just happened like 2 days ago. So we have a golden cross. We're not at bottom, so obviously max opportunity would have been in the 40, 50 cent range, and that's over 100 plus, 120, 30, 40, 50% from the price point of where we are. But a golden cross is a golden cross, whether you're talking about equities land or crypto land, it doesn't matter. From a technical perspective, and this is like more of a conversation that capital gains folks would entertain. So what would be an entry type play for capital gains? Frankly, what is screaming right here? Because we've historically talked about capital gain strategy, and I'll show you guys if I could find. Where's the drawing tool? Not text. Here, brush. So what have I always said about capital gains? Breakout, retest, higher high for the bullish, the trifecta of bullish confluence. Breakout, retest, higher high. That's the entry from a technical perspective. Now, bear in mind that's also an entry from a maximum confluence tech perspective, because obviously this would have been the max risk, max reward type region, probably down here at 48 cents, which was a higher low. So we have on the daily chart, low, higher low, higher low. So notice the spread between the higher lows significantly increasing. Notice the golden cross. Notice the trifecta of bullish confluence with the breakout above the 200 SMA on the daily chart, the retest, and then the higher high. So from a daily perspective, there's significant confluence going on. Now we go to the weekly chart. Let me see if I can clean it up. Clean up. Clean up. Boop. Boop. Weekly chart was somewhat of a retest of the weekly TWAP, not really, more of a weekly retest of the 10 SMA. But we had the breakout of the 10 SMA, of the TWAP, push right through strength. If you're considering the confluence of the daily chart, the strength was it didn't even hit a full retest, but it breached right through the 50 SMA. And we've been waiting for about a week because we had our wick end of last week through the 50 SMA. But as you can see here, we pushed through and we retested meaningfully to the downside, down 10 cents on the dollar, and we're pushing upward. So right now it's holding the previous high as resistance, and you can literally see that right here. Now, I'm not really going to put lines, but I'll show this. Like previous high as resistance. So it failed to breach that resistance level. So for more bullish confluence from a weekly perspective, you want to see previous highs breach to the upside, producing a fresh higher high. It's early for this kind of analysis, for putting this line in. So I'm not too fond of this line. Let's take that out. I like these two lines down here, but we're above them at this point. And then one more piece of technical data that I find fascinating. So we breached the 10 SMA on the monthly to the upside, and this was a clear retest, a breakout, and then the higher high. So even this has the trifecta of bullish confluence. Problem is, it's in two candles. So two candles, that's not much of a technical data to go on. So the most technicals we have is the daily that gives a fair amount of candles to make some nice observations. What's meaningful in this chart is RSI. This is the first bullish signal cross of monthly RSI that Curve has ever had. Obviously, it's a relatively new asset dating to the data set that we have here of October of 21. So from this technical data, this is the first bullish cross of the monthly RSI signal. So I find that quite interesting. And to top it all off, if you look at MFI, which is basically RSI that considers volume, it's bottomed out. So if this is a significant increase in liquidity, global macro conditions are favorable, price appreciation is expected to continue, MFI is bottomed out. So this has technical indications that this hasn't even started yet, which is quite interesting. I mean, historically, I like to do this every now and then. This is Curve. This is the entire technical data set for Curve. Look, it's small. Look how small it is. Isn't that wild? So it kind of just started. Everyone gets so hyped up and roaring like, oh, it's a bull market. It's hard for humans to put shit into very long-term context and to have a long time horizon and compartmentalize time periods like 2020 and 2021, 2022 is 3 years, and what's going to be in 10 years? What was it in the mid 2000s, 2015, 2010, 2005? And all these periods are related to one another. And this is a very interesting perspective to have, and this highlights how small it really is with regard to technical data, and that's why we look at fundamentals. That's why we look at concepts like windiness, concepts of emerging market liquidity, and what does Curve do for this particular emerging market. And then we understand what this system does. What is the likelihood that the system succeeds and continues to exist into the future? The longer a technology continues to exist, the longer it is more likely to continue to exist. And that's lindiness, and lindiness is recursive and it's self-reinforcing. And this chart is very interesting in that regard. Any comments that I miss? Sarko, breakout retest higher high for bullish confluence. Mental note me. Yeah, that's from a capital gains perspective. I have obviously I've been keeping my eyes on Solid and all the solidly forks. Now I'm out and I appreciate what they're doing. I just I don't want to participate in all the drama. So when one protocol forks another, there's so much drama all over the place, especially between solidly mainnet and Velodrome on Optimism. And how many freaking forks are there in Arbitrum at this point? I mean, even Grail, I think, has components of this system. So I'm just, I'm like, I'm out. It's all good. The most important thing you can learn as a capital manager, managing your own personal finances, is you can watch an asset just significantly outperform and be like, all right, fine, I'm done. I just don't want anything to do with it. And that's okay. That narrative that went around in 2020 was have fun staying poor. And it's a disgusting statement, but that's besides the point. But sit back and watch an asset significantly outperform and don't bat your eyes. It's okay. It's fine because there's endless assets. I also always tell you guys you can't own everything. So what you have to do is identify something that you can have a concentrated bet on. Buffett and Munger, their distaste for the crypto space has nothing to do with the significance of their investment methodology that can be directly applied to the crypto markets. Concentration changes the portfolio structure. Diversification protects it. No one made a fortune diversifying. No one made a fortune excessively diversifying. There's a tendency with newer participants to investing to want to own a little bit of everything. And that is not a way to achieve one's goals. To achieve one's goals requires concentrated bets, and which is a complicated equation depending on the size of the portfolio, and we're not going to get into that, but suffice it to say, that is my rationale for I'm out. It's okay. I'll watch it go up, enjoy. I'm happy for everyone. Happy for all the vested interests. Hopefully, they're able to cash out some of their money, and that makes me happy. Uh, and it's just, I feel bad because I really wanted a bit of exposure to what Andre originally visioned, but that's okay. I have plenty of exposure to derivatives of what he built. Fixed Forex, I still have a position. Tapioca's coming out, and that has components of everything that Andre talks about, and has components of what Curve started, and it even has the options as the incentive, which is great, and that's cool. That's what New Bunny Finance has. Wow, incredible volatility. The Bunny Finance incentive, Lit, part of Limitless and team, has options as the incentive. It's not just a raw token. The option basically says all emissions, all increase in circulating supply produces income, Ethereum denominated. So this changes the mechanic of how the balance sheet flows with regard to income versus capex. So this is quite interesting from a technical perspective. So moderates, it's small cap, it's $5.9 million. Heck of a, not really a heck of a FTV. It's small, and it's just trying to find its legs, and it doesn't have everything that I would say is necessary for critical mass yet. Surely there's no vote rentals. So these systems are completely dependent on vote rentals. So in that regard, it's a punt. From a technical perspective and a capital gains perspective, sure, yeah, I guess you could play it. It doesn't have a lot of volume. So without a lot of volume, you're going to have a lot of trouble assessing capital gains opportunities. You're not going to have ascending triangles, you know, falling wedges. You're not going to have your technical structures that help you identify. There's no perps, so you're not going to have short squeezes, or, long squeezes, so on and so forth. So this is something that caught my eye, particularly because of the incentives being paid in options, which produces income for the protocol. Suffice it to say, that is what caught my eye. Grail obviously has been hot on Arbitrum. Such a restricted supply. FDV is quite reasonable. Liquidity is only 15 mil. Market cap of 28. This can do some miraculous things. What restrains me from deploying excessively or deploying at all? I can't get the position size I would want. One. Two is predominantly this. I'm happy for folks that are outperforming. This is no discredit to what they've built, what Camelot's doing. They're getting a lot of partners, which has a lot of vote rentals, which is a big deal. That's what's needed for the system to work. Great. Great. I'm happy for folks that got good prices and I hope they're getting good yield. And they are. They probably are. That's why I'm interested in the protocol. But if I can't get a favorable position, I can't get something that's going to be best suited to my interest, I'm just not going to take a position. That's to no discredit to my interest in it. That's the bottom line. So what's one of the bigger reasons why I restrain myself on the L2s? It's liquidity. So sure, we've seen significant capital inflow to Arbitrum. 12% week over week is absolutely massive, which is exactly why we're seeing all this bullish activity. 12% on $1 billion. It's $100 million of fresh capital inflow. So it's $1.28 billion. That's my problem. Ethereum mainnet is $78 billion. So, Arbitrum optimism is bleeding out a bit, minus 11% for the last couple of weeks. It's a fair amount. It's a lot of millions of dollars drained from a $608 million system. It's a very micro system. Polygon's still marginally negative sum, $1.75 billion. These are small micro markets. 9 bill on Binance, it's irrelevant, no interest, and nobody plays on Tron inside the United States. It's an outside the United States phenomenon with 94% tethered dominance, $38 billion. This is big outside the United States. So for mid cap, mid to large size portfolios, Ethereum's the playground. You can have fun on Arbitrum, but that's not where the real money is going to be made. Arbitrum's outperforming. This is the playground right now. If you have a moderate sized portfolio, small size to moderate sized portfolio, Arbitrum is the playground right now. And, explore the capital gains. You're probably late for investment. Big difference between capital gains and investment. Investment is more of the value investing. So capital gains are any market, bull market, bear market. So, but what you want with capital gains is volume and volatility. And what kind of volatility are you going to get with a 12.69% increase in systemic liquidity in a week? That's like, come on, pick a country. Getting 10% increase in currency units in a week? It's going to send everything into a frenzy. And that's exactly what's happening on Arbitrum, as you see on social media. So Arbitrum is the fun network. That's the playground right now, and that is worthwhile to explore. It is very worthwhile to extend restraint with hundreds of millions of dollars worth of capital inflow. All right, maybe 100 or 200 million dollars worth of capital inflow over the last 2 weeks. Expect capital drain. Expect capital flight as the trend reverses. Why? Cycles will cycle. Capital inflow is followed by capital outflow. Capital gains go back to mainnet, exploring other markets that have yet to experience exuberance. Be careful. The excitement is on Arbitrum. Doesn't mean the excitement can't flow over to Optimism, Phantom, ZK, whatever the hell that comes. Polygon has a heck of a narrative and that has experienced significant outperformance many times over the last couple of years. Who else is here? Brian's in the house. Morning, Captain. A pleasure. Well, I hope that helps, guys. What else did I have? Those are all the charts I'm looking at, aside from macro stuff. Look what's going on. Aura's on fire. Absolutely on fire at 365. This makes that low down here a $1.40. That was fun. Where did I get? I get my position probably $1.80, give or take, right about here. So I had to sit down through 40-cent decline, and now it's up 100%. So that's nice to see. That's refreshing. What else? We looked at curve. I mean, look at this. This is just it's a bullish hammer on the monthly. You don't see hammers often. A close where there's no wick. It's just full candle body close. Buck 27. This is nice to see. What else can we look at? Let me see if there's anything else we could look at real quick. Because I know the market's hot and I know you guys want to talk about stuff. Adam's doing well. That's good to see. Frax, obviously. Damn, look at Stargate. Let's look at Stargate. They got hit hard because they significantly increased their circulating supply. Big incentives. Big incentives. But Stargate's doing pretty good. Let's look at it on Arbitrum. 3%, big wicks. Let's zoom in a little bit to the 4-hour. I mean, this is where you're at. Look at that. A breakout of the previous high. Now notice these wicks. These are large buyers. These are market movers. These are someone coming in with, a couple $1 million. And they tend to change the direction of markets. Now this one took a long time. August 22nd. This took months. But look, he bought, created this massive wick to the upside, and literally right now, it looks like it's going to hold it as support, considering overall market conditions. Breakout, retest, and then the higher high. $1.41, and this guy who bought at 34 cents and overpaid significantly is going to be like, finally. And it's got a ways to go. Let's go into the daily. I mean, look at that depreciation, but now it's, even on the daily, that guy's wick is kind of like, he's sitting pretty. If it goes down to $1, which is a 13% decline from here, it's still a retest of pretty much the high that he started. So large actors change the direction of markets, and then the aggregate follows in line. I like Stargate. Wonderful asset, wonderful tech. Yeah, Mark, Aura's doing some crazy stuff. XCal. What's an XCal? Heard it. Oh, I've heard of this. Yeah, microscopic. Careful. It wouldn't be something I'd be interested in. But from a technical perspective, now bear in mind from a technical perspective, it's up 400% in 20 days. You need a significant, well, here was your significant retest. Your retest has passed. So you're looking right now for resistance. And then you could short. And it's not really something you could short because it doesn't have that kind of market set up yet. So you're looking for the capitulation. And frankly, it looks structurally decent for capitulation, albeit it's a flag type structure. But 3 hits on resistance, you can see a nice rundown. What you'd want optimally is a 23-cent support. And in this kind of market, a support is more favorable than a support in a bearish market. That is not a favorable position to be in a bearish market, but this is a bullish market. So you look for supports, and this is not something I'd be interested in, but I can see why other people are literally exploring the gamut of all the micro coins in the market. Yeah, it's a solidly fork. Go figure. Yeah, my general sentiment is I want nothing to do with any of the solidly forks at all. But, just be careful. Just remember that capital gains is adversarial. Someone is going to dump on you. The whole question is whether whether there is more capital to come in and push the price back up. And that's a very traditional chart pattern. If someone dumps, the aggregate comes in. The people that say, the price is down, and they push it back up. And that's the staircase pattern. Dump, aggregate comes in, and they push the price back up. So it's an adversarial game, player versus player, really driven by the large actors that could throw around $1 million. The problem here is this type of liquidity, someone could buy it all. And someone probably does own it all. Someone comes in with 300 grand and they're going to have ridiculous slippage. And it's going to go to like a tremendous value, like, $1.20 on a single wick. And then vested interest is going to exit, but now this person pretty much owns all the liquidity. So any trading that goes on, they're getting all the trading fees, bought all the liquidity. So assets of this size are prone to takeovers. If someone buys all the liquidity, it's been taken over in many regards. So, it's complicated. The adversarial nature, the biological stories we told of predator and prey, lions and antelopes and rabbits, the story I've told you. So there's care and caution is needed. Just remember, quick trigger, in, out, that's fine. Just be careful. So that's the deal, Snake. All right, 49 people in the stream, 18 likes. I appreciate all of you. Hit that like button, smack that thumbs up. Tell everyone to subscribe, because if folks don't listen, I can't help them do a little bit better. Monday, February 20th at 12:43 p.m. You know the deal. After party on Discord for the most rational community in the entire crypto space. I wish you all a good one, a safe week, and I will see you again on Friday. Peace.